Good morning, good afternoon, good evening, whenever you're watching this. My name is Lena Riscala. I'm a financial advisor with Conte Wealth Advisors. I'm based in New York City and the Hudson Valley. And I work mainly with women, small businesses, and helping Gen Xers prepare for retirement because it's coming up. So I've had a lot of experience in the industry, about 20 plus years working for major financial companies, doing a lot of research on retirement planning, taxes, legislative policy that might affect the financial industry. But I really enjoy working with clients and helping them kind of work through the puzzle of their life and how to get ready for certain life events. Today, what I'm going to do is I'm going to talk a little bit about this crazy year. I'm sure all of us have felt a little on edge and a little bit of anxiety and a lot of uncertainty in our own ways because, as everyone says on TV, we're all in this together. This pandemic came for many of us, it's just out of the blue and out of nowhere, and it's really changed our lives and impacted the way that we do a lot of things, right? So socializing is different. How we go to work is different. How we send our children to school and how they are educated. Traveling has kind of come to a halt. So a lot of the things that we maybe took for granted in 2019 have really, really changed, and we've had to make a lot of adjustments. And that's also caused a lot of uncertainty in our finances, right? So this year has with the pandemic and a shutdown, it's resulted in a lot of layoffs and furloughs and the unemployment rate going pretty high, the stock market becoming very uncertain and very volatile, the economy, seeing a lot of things happening in the economy that make us a little bit nervous. So what I want to do today is I want to talk through the events of this year, not to bring up dirty laundry or kind of negativity, but really, what are the lessons that we've learned? What can we take away from this year? Hopefully not to prepare us for another pandemic, but just for whatever happens down the road. As life kind of bumps along, we're going to have to be prepared and know how much should we be saving? How should we be investing or diversifying our portfolio to prepare for the volatility that does come with life? And then we're going to talk about 5 year-end strategies that I like to talk about at the end of year, every year, that really help you become more tax efficient. It helps you kind of rethink what you're invested in now and how you should maybe change or rebalance. And then finally, we'll talk about what's to come. I don't have any crystal ball. I can't tell you what's going to happen in 2021. Hopefully, it will be better than 2020, but there's so much we don't control, but there are a few things that we do. And we'll talk through a couple of things that we do control that we can manage and hopefully put us in a better place for a prosperous 2021. So you don't have to look at my big moon face during this presentation. I'm gonna take you through my presentation, some slides. I don't know why this is, I don't know why. Let's go through. I guess it went on ahead of me. So did this year really happen? So we're going to make sense of the weirdest year ever. We're going to talk about 5 end-of-year planning steps and then prepare for a recovery. So just to get started, I'm going to move me out of the way. Just to get started, what we're looking at here is two different charts that really correlate to each other. The top chart talks about the major pullbacks or the worst day in a given year over the past 10 years. So it goes from 2010 to 2020, where we are today, and I guess end of the third quarter, September 30th, and all the major pullbacks since the financial crisis. The bottom chart shows volatility, the VIX index, which basically shows the level of risk, which really goes to the level of risk and how risk affects the markets. You can see as volatility goes up, right, the market sometimes dips. It often dips, and it often takes a small to a large dip, depending on whatever triggered that volatility. And what does that mean to us? Well, like I said, it really is all about risk, and it's caused by a couple things. One is it could just be caused by economic forces, right? So the Fed cuts rates, or inflation goes up, or China or Europe is getting into a recession, that could create some volatility in the market. The other event that could happen is, like I said, events, right? So the BP oil spill or a pandemic, certain events that happen in the world can also trigger volatility. Now, why is this important? It's important to know why the market dips, right? Number one, is because certain things happen along the way that create a little bit of nervousness. But the biggest takeaway from the slide is that even though there could be these extreme ups and downs of volatility that also are reflected in the market on top, the market in general continues to go up. So if you look back to history, back 2010 and even beyond, maybe, or even before that, 2000 to 2000 to 1990 to 1980 to 1970 and beyond, you'll just see this upward trajectory of the market regardless. So I know it's tough to consider this now where we are sitting, where kind of in this place of like not being sure of what's going to happen next. But just to kind of look back, and if history is our guide, yes, there might be some bumps along the way, but in general, the market continues to go up, it recovers, and it goes up. So at the end of the day, it's important to stay invested, to be invested and to stay invested. I'm going to talk about volatility later on when we talk about our own personal finances, but it's important to just remember that volatility it really does reflect a level of risk. And as investors, we should really understand what is our risk tolerance, like how much volatility can we take before we want to take action, before we become emotional over our money and take action and maybe take the wrong action. This is one of my favorite slides. These are JP Morgan slides that I'm using. And this one is really one of my favorite because it really does show that a down day doesn't mean a down year. And what this chart reflects is in the gray bars that go up and down, that shows the overall average return of that particular year. And the red dot, a number, reflects the worst day in that year. And you can see since 1980 to 2020 that over that 40-year period, annual returns were positive 30 out of those 40 years. So even in a year like 1987, when it was down 34, the market ended up 2%. I mean, 2% is not a major, but when you were down 34%, it's good news, right? And likewise, at the end of this year, we don't know where we're going to end up, but 2020, you could see the market went down 34% back in March 23rd, but by year to date, which it means end of third quarter, we are up 4% and probably up a little bit higher than that as the market's rallied over the past couple of years. So it's important to know this. Number one, the market goes up and down. A bad day doesn't mean a bad year. And especially again, when we're investing, even in a pandemic, like even with all this bad economic news, all this bad market news, we can still see how the market recovers. And that's really important to consider and to remember as we're investing. The last thing I'll leave you with is over this 40-year period, a lot of times people say, my clients will say, oh, like how much can I make with this money if I'm going to invest it for 10 or 20 or 30 years? What's the takeaway? Well, this was invested in the S&P 500. It basically tracks the S&P 500 for 40 years. And even with those major drops of minus 34, minus 49, minus 30, minus 34 again, the average, those were the average intra-year drops of 14%. It was still positive over that time period. So it's really important to remember that. Now, another thing that the pandemic has changed is how we spend, right? Because a lot of us are spending more time at home. We're in our pajamas. I mean, maybe I'm wearing leggings right now. I'm not going to say, but it's probably possible. And we're working from home. Our children are in school at home. We're not eating out as much. And if we are, it's like outside in the middle of the street as buses go by. I think alcohol sales are up. I mean, they are in my house, but it's just people are just living in a different way. And so what this chart shows is just how spending has changed over the course of the last, say, 8 months. And this is another JP Morgan slide. They looked at different indicators. They looked at Chase households, people that bank with Chase. They looked at certain app usage. say Airbnb, Google Maps, Booking.com, and Uber to see how much usage and how the usage has changed over time. And they looked at like TSA to really note what has been, how it has changed year over year. So from last year, what is the change in each of these different types of spending? So TSA traveler traffic, you can see back in March and April, it was down 96%. It's come back up just slightly, but you could see that very light blue line that it's still really struggling to get up as just the airlines continue to be crushed and travel is kind of not quite at a standstill, but it's very, very reduced. Seated dinners, that was minus 100% back in April. People just did not go out to eat because they couldn't. Everything was closed. But as the US started opening back up, you could see a shift towards more people going to have seated dinners, even though it's been just, not a direct upward trajectory because people, we're at a limited capacity with restaurants, and some cities and states are shutting down as the pandemic spikes. But you can just see just how hard it's been for a lot of these different industries: traveling, dinners, travel and navigation app usage, hotel occupancy. All of those have really struggled to get back to normal and just aren't there yet. What has been doing really well is mortgage applications, because the rates are so low, and people are just moving. There's a lot of movement from cities to suburbs. Up here in Beacon, I'm seeing so many new people from the city, from all over, that are kind of fleeing New York City, maybe for the meantime, or maybe for making a life change to an area has a mountain and clean air and maybe less COVID, but probably not. We just don't know. So there's a lot of that kind of a change. This also reflects the S&P 500 by sector. So you're seeing kind of what are the winners and losers of this COVID era. And you can see the top three: online retail, 60% returns, home improvement, and then information technology, and then groceries. And the fourth, just online retail, I know, I believe it was led by Amazon, right? So Amazon has about 35 or more % of the market share of online retail. Followed by Costco, Target, even the smaller retails, the Lululemons and the Peloton. Those are really doing well because people are staying home. They're putting their dollars towards whatever they can get online, delivery. They can exercise at home. They can shop at home. A lot of that has happened. Home improvement is really big, as many of us know. Driving around Beacon, you can just see everyone's working on their home. My brother has a home improvement company, and he said his business is booming because people are home now, and they're looking at the toilet and saying, oh, this is kind of shaky, let me replace it. The HVAC needs to be replaced. Let's tear down this wall and do something with it. So there's a lot of that happening. The losers, as we know, energy's had its own rough year. Airlines, hotel resorts, and cruise lines, they're the losers as well. Maybe the stocks have come back just very briefly this week, as we got good news of a vaccine, but not, I think, I don't know how long-lived that's going to be. One of the big questions I've been getting from clients this year is why is, when the economy looks so shaky, when unemployment rate is so high and businesses are going under and people aren't traveling, and there's just like a lot of bad news, and people are on unemployment, record number of people on unemployment, why is the market doing so well? And I don't know if this is probably like a tribute to one of my favorite movies, Zoolander. If you remember Mugatu, why is the market so hot right now? Remember that? Anyway, so why is the market hot right now? And just to kind of highlight the third point, the market is often forward thinking. And what that means is the market's going to already account for the news that's going to happen in 6 to 9 months. So they're thinking about, okay, given where we are today, plus all of these other considerations, whether it's policy changes, whether it's rate cuts, whether it's seasonal events that happen whether it's certain sectors that are going to do well or bad and historically have been doing well or bad in certain times of years. How should we be, how should we be thinking about it? And the market is going to be thinking 6 to 9 months ahead of time. And so when I showed you in the past, in the earlier slides, when the market went down 34% back in March, it was looking at, okay, if we're shutting down, what's going to happen? Like the economy is going to shut down. People are going to be on unemployment. A record number of people are going to be on unemployment. And so it really did, that bad news, they kind of shook the markets. But as you'll also see, if you looked in the past slides, the market recovered quite quickly. Even as the economy, we kept getting worse and worse news. New York City was shut down throughout April and May. The big financial company, the capital of the world, I don't know, definitely the country, made a kind of a ripple effect. So we definitely saw a lot of economic bad news, but the market recovered. And again, it's because the market was pricing in the Fed cut interest rates, right? So it was pricing that in, the fact that it was easier for people and businesses to borrow. Policy considerations, the CARES Act was passed. So all of a sudden people got their stimulus checks, they started, unemployment was expanded, the PPP loans were going out. So there was money flowing into, or going to be flowing into the economy, and into the hands of consumers and individuals and families and business owners. And the market already accounted for that. And so that's why when it saw this good news happening, it quickly began to recover. And so that's kind of the reason why it is. It's like often it's forward thinking, but it accounts for things that are happening today. What this chart shows is it's 3 towers, and it basically kind of gives you kind of an explanation or an illustration of how things that are strong in the market may not be reflected in the economy, right? So the 2 towers on the left, nominal GDP, gross domestic product, which is basically growth. It's whatever goods and services and the profits and the growth of goods and services in an economy. What is the makeup, right? What are the different areas that make up GDP? And then the second, or the middle one, is employment, right? What sectors make up overall employment? And then on the far right, it's the S&P 500. So what are the industries and sectors that make up the S&P 500? Now we know if you have been invested, you're probably somewhat invested in technology. And that sector, along with healthcare, has been leading the charge, the upward trajectory of the market. Apple, Google, Amazon, Netflix, Facebook, all of those have really led the market going up over the last year or so. But if you look on the left, on the 2 towers on the left, the technology is not really reflected so strongly in employment or in GDP, right? So where technology takes up about almost 40% of the S&P 500 and about 35% of S&P 500 earnings, it has a minimal impact on employment, 2%, and minimal impact on GDP, about 6%. You can see healthcare is a little bit more correlated, right, with GDP, with employment, with makeup of the S&P 500. But just to kind of give you an example of how, in some cases, the industries and the sectors that really deliver the market don't actually show up as much in the economy. So just kind of, I guess, the moral of the story, markets as forward thinking. Again, stay invested, even if you get some bad economic news. As long as you're in a diversified portfolio, the best case scenario, and under most circumstances, is to stay invested, even when there's kind of shifty news. Now, I love this slide. We just finished an election, I think, even though I think it's being contested, the results are being contested. But I think what this chart shows is that even if we have good economic news, the perception of positive, a good economy sometimes depends on what party you're affiliated with and what party is in power, right? So obviously on this slide, the red is Republican, The blue is Democrat, and then in gray, it's a total. And it basically charts from 2000 to 2020. Along the way, the higher the line goes, the higher the percentage of that party who rate the economic conditions as excellent or good. So we see in the Bush era, right, from 2000 to about 2008, we had a huge economic boom after 2004. And you could see Republicans were really along with that. They thought, wow, we're in really good shape. Democrats did not believe to be in really good economic shape. Now, it could depend on, you know, the economic impact of individuals who call themselves Democrats or who call themselves Republicans. So it really depends on those various things. During the Obama era and during the big recession in 2008, 2009, everyone was pretty subdued, although you could see Democrats still felt a little bit more optimistic than Republicans did. And then again, as we get into the boom of after 2010, Democrats, again, were still pretty optimistic during the Obama era while Republicans weren't. And now during Trump, you know, obviously there was a lot of support and excitement over the Trump economic policy. And just kind of interesting now where we are today, during a pandemic with shaky economic news, but a very strong market, the Republican Party tends to be a little bit more optimistic or see where we are today as a pretty good or excellent economic conditions. So let's talk a little bit about 5 steps to wrap up this godforsaken year. I think these are all pretty standard things that you can consider, but it's always good to remember to do this. We still have time before 2020 goes away to look at our portfolios and make sure that we can take care of the things that we need to take care of to be more tax efficient, to invest properly and wisely, to make the contributions we can to our retirement. So first and foremost, I think saving is the most important building block for a financial foundation. Whenever I meet with clients, I stress that saving is the most important thing to do. Setting the financial foundation is to first and foremost establish an emergency fund. Now, this is about 4 to 6 months of living expenses. So it's everything that you need to keep the lights on, to pay the rent, to get in your car and drive, to put gas in your car, food, all of those healthcare, all of those are needed expenses that you should make sure that you have enough on hand that if something happens, say, I don't know, a pandemic, you'll be able to be okay, generally speaking, for at least a few months before you get another job or, you know, life changes or the pandemic goes away, who knows. But definitely that. Now, I had a question last night from somebody who said, well, I am trying to save to open a small business. Is that like an emergency reserve? The answer is no, right? So the emergency reserve is 4 to 6 months of living expenses that you are putting aside, that you're keeping for a rainy day in case something happens that you're going to need to tap into it and pay your expenses. And as you need those expenses, so as Billy needs braces or the car falls apart and you need to buy a bunch of new parts or somebody has emergency surgery or whatever, you replenish that. That's the first thing you do, is replenish that emergency reserve. So you always have that cash on hand. If you're thinking of building a business, which a lot of people are interested in starting businesses now after this pandemic, great. And there's nothing to say that you can't put money towards an emergency reserve while you're also saving for your business, but it's not the same thing, right? It is not the same thing. The second thing you want to do is make sure that you're saving in a retirement account. So putting money into your defined contribution, your 401k, your IRA, I think it's $6,000, $6,500 max for an IRA for people under 50. I think you have an additional $1,000 that you can put towards an IRA for 50 and over. I think for a 401k, it's about $19,000 or $19,500, an additional $6,000 for people who are 50 plus. Make sure that to the extent that you can, that you maximize your contribution at least to your company match. So if your company matches you 3% or 5%, do as much as you can. Get that free money in your 401k and also in your HSA, your health savings account. If you have that, definitely take advantage, and I'll explain that on the next slide. So make sure you're doing that before you pay down high interest debt. So look at your credit cards, look at all the loans that you have out, and make sure that if you have that 18% loan or credit card, you're starting to put money towards that first and foremost before you start paying down other types of debt. That's kind of should be the hierarchy. Now this year, because the market has had a lot of great buying opportunities, a lot of people have asked me, look, I have $15,000 or $10,000 or $5,000. Should I just buy Tesla? And I don't, maybe you should buy Tesla, probably not, I don't know. My question is, well, first of all, do you have an emergency fund? Have you made your max matching contribution to your 401k or to your HSA? Are you out of debt? If you say no to any of those, then you should not be investing in a taxable account. If you say yes, you're out of debt, I'm in good position, I'm in good shape, then absolutely, I can help you invest. Or if you want to do a $10,000, $20,000 Schwab account and just learn and play the market on your own, do that as well. But first and foremost, set that financial foundation. And then with regards to retirement accounts, definitely consider, like I mentioned, make sure that you're making the annual contribution, you're getting the company match, and you're matching out the contribution if you have it. The two different accounts that I would talk about is the pre-tax 401k. So it's your 401k, it's your earned income that is not taxed, that goes towards your 401k and grows tax deferred and then comes out taxable to you. So it's basically going to come out taxed at your ordinary income tax rate in retirement. That's how a regular 401k works. If your company also offers a Roth 401k component, consider taking advantage of that as well. So whether it's shifting a portion of your pre-tax contributions to your 401k and then a portion of your after-tax contributions to your Roth 401k, the difference here, two differences, is that your contribution to your Roth component is going to be taxed, and it's going to go tax deferred just like in your regular 401k. But when retirement happens and you start taking money out, you're going to take the money out tax-free. And that is really, really important. And having tax diversification in retirement is really, really important. So think about that. Like I mentioned, the HSA, if you have access to that, definitely take advantage. That's like a triple tax whammy, right? So health savings accounts are different from FSAs, flexible spending accounts. FSAs is your own money, basically, that you fund. That's pre-tax money that you fund up to a certain limit that you have to use for healthcare before the end of the year. Some companies allow you to roll it over. You should check with your HR department, but a lot of times it's a use it or lose it situation. And HSA is a little bit different. It's qualified, which means that you're going to use your pre-tax money that goes into the HSA. It's going to grow. Your company may make some contributions to it. And then when it comes out, it's also tax-free. So it's a triple tax whammy. Money that you earned is not going to be taxed. The money that as it grows is not going to be taxed. And then the money that comes out, if it's used for medical purposes, is not going to be taxed. So to the extent you have this and you can make your contribution, I think the max is like $3,000 or something like that. Do it. It's a great feature. Roth is important too. If you have access to a Roth, or if you're considering doing a Roth, I definitely think that this is a good time to consider it because we are in a lower tax environment, especially since the Tax Act was passed in 2017. Many of these tax brackets are supposed to revert back to the higher tax levels by 2025 unless Congress steps in. So it could be a good opportunity now to convert your traditional IRA to a Roth IRA or to make Roth contributions. Now there's three reasons, there are three right times for a Roth. One is early career, when you are making like probably the least amount of income that you'll make in your career. You're in a lower tax bracket so that you're not going to have such a big tax hit. That's definitely a good time to establish a Roth IRA. If you're in your kind of your middle of your career and you are making some good income, but you are could be maybe putting money away, that it could be a good time as well to to put that money away. Or if you maybe lost your job, or you got furloughed, or you are taking some time off, or you're just seeing yourself in a lower tax bracket, definitely take advantage of that. And then finally, if you are seeing like retirement is happening in 10 years and you've done really well saving in a 401k, you have $500,000 in your 401k, consider that when you start taking required distributions, those distributions will have to come out, and they're going to be taxed at your ordinary income tax rate, which could be 25-30% plus. So even if you are in a high tax bracket, talk to your accountant, but it could be a good idea to maybe shift some of your savings from the pre-tax 401k to your Roth 401k option. The CARES Act that was passed in, I believe it was April or May, actually allowed for a lot of opportunities to take money from your IRA, from your 401k. So if you still need to take some money out of your 401k or IRA, from your IRA, you'll be able to do so without having to pay that 10% penalty, which happens if you're under 59 and a half and you take money out of your IRA, you get hit with a 10% penalty unless you hit one of these exceptions. But in general, if it's a COVID related need, you'll be able to take money out without getting that 10% penalty. You will have to pay ordinary income tax, but you won't have to get hit by that 10% penalty. And then just take advantage of some tax strategies as well. One of the things the CARES Act did was it allowed a charitable tax deduction of $300, even if you are taking the standard deduction. So generally speaking, if you do charitable deductions, in order to get credit for that, you would have to itemize on your tax return. This year, because of the CARES Act, you can still claim the standard deduction and take a charitable deduction up to $300, which could also be helpful in saving taxes. Qualified charitable distributions are still available from your IRA. If you are somebody that's over 70 and a half or 72 that has to take your required distributions but you don't need it, you can make a qualified charitable distribution, take the money out and direct it towards a charitable organization, and that could lower your tax liability. And then take advantage of tax loss harvesting to get your account more tax efficient. So what's next, right? You can tell that I like Will Ferrell movies. Again, I don't have a crystal ball. We don't know what's going to happen. We don't know what the future holds. But again, as much as there's so much that's not in our control, there's also so much that is within our control. So this slide basically shows the potential road to recovery. And again, even according to this asset manager Capital Group, or American funds, they're not sure which shape the recovery is going to take, right? We talked earlier about a V-shaped recovery, earlier in the year, about a possible V-shaped recovery where, in March of this year, March and April, we hit rock bottom, and then we come back up and we recover. That may not be happening just because of the repeated shutdowns and fear of a second or third wave in the pandemic. So it could be a U-shape where we hit another bottom, but maybe not as deep as the one that we experienced in Q2, or maybe it's a W shape where we hit bottom and then we hit it again, and then we start recovering, but it's not such a strong recovery as the V or the U shapes. Again, it remains to be seen, and it really depends on three things. One is how quickly we can transition to the new president, whoever that is. Obviously, we had an election last week. It is being challenged right now, and so as much as we can get certainty from the results of the election, as quickly as we can get them, the more that it could likely drive more positive economic factors. The second is policy. So Congress has been talking about a third round of stimulus. The Republicans I think their proposal is about $500 billion. The Democrats are proposing about $2 trillion. And that's just a means to get cash in the hands of individuals, maybe expand unemployment benefits, maybe do another round of PPP for businesses, and maybe even funding state and local governments that are really having a hard time making ends meet. So it remains to be seen, but the sooner that we get some type of policy direction, the more likely we'll see a better chance for recovery. And the third is obviously getting the pandemic back, kind of getting it under control, making those second or third waves as minimal as possible, controlling the shutdown so that it doesn't have such a widespread negative effect on the economy, on the local and the national economy. So it all remains to be seen. Again, uncertainty, it's been the rule of 2020, right? But again, there are some things that we can do to make sure that the lessons that we've learned this year, right? Saving, investing, making sure that we know we're prepared for most of the things that could happen, that we're doing what we can. And this slide, I think, it's one of my favorite slides because it really shows how we need to approach investing and saving in a very pragmatic, sober, boring way, right? So not exciting, not like chasing stocks or chasing whatever, and not fearful, like putting everything in cash, but really having a very strategic approach to how we save. And what the three donuts show is basically our goals and our money, right? Aligning our specific goals with a specific pot of money and a time frame. So for your short-term goals, right? 3 to 6 months, what do we need? Making sure we have, 3 to 3 years, up to 3 years, including your emergency reserve fund, making sure we have cash or cash equivalents, whether it's regular cash in our bank accounts, whether we do long-term money market accounts that we're saving up for a small business in the next 6 months or a year, we're saving up for a car or a trip or whatever it is, putting that in something that's going to generate a little bit more interest, but still can be accessible if we need it. For our medium-term goals, 5 to 10 years, you're saving for college, you're saving for a home, you have the time to take on a little bit more risk, right? So you can do a little bit more equities, you could have stocks in there, and bonds, fixed income, and cash. And then for your long-term goals, that's 15 plus years, that's more for retirement. And when you're thinking of retirement, you really do, and you do have time, you have 10, 15, 20 years to save for retirement. You really do have the time to invest in riskier assets, like in equities, and having a diversified portfolio of equities and bonds will give you the results that you need. And a diversified portfolio is the best medicine for volatility. Remember the first slide or two that I showed you, the bottom chart showed volatility, and there was all these reasons why volatility spikes. And it affects the market in ways, which was clear on that slide. With regard to your own portfolio, this could be the case as well. So what this chart shows is each box and colored box indicates a specific market sector, right? You can be invested in large caps in army green, or cash in purple, or high yield fixed income in that turquoise. No one is going to be the winner and no one is going to be the loser. But you could see along the bottom that cash is usually on the bottom in terms of returns when compared to other types of sectors or other asset classes in the market. But if you follow a diversified asset allocation portfolio, so that's gray, the gray box is in the middle with a line through it. It's a little bit of a roller coaster, but it's absolutely a roller coaster that I would ride on, right? Because it's not so scary. It doesn't provoke me to feel emotional and feel nervous about pulling out, because it's going to be a diversified asset allocation. It's going to take into consideration my level of risk that I'm comfortable taking, and my time frame. What do I need? What do I need this money for? How long do I have? And it's going to take into consideration all the good things that I need to implement from the market into my portfolio. Now, you're not going to get the highest yield, right? It's always kind of in the middle. But if you look on the very far right-hand side, it's volatility, you can see that it's relatively low. So the ride, you're getting the returns that you need over that long-term period, but the ride is pretty smooth, right? It's not as high as, say, REITs or emerging market equity or even small caps. So that ride is a lot bumpier, it's a lot scarier, and you're more likely to get out in the scary times. This just kind of shows you, just the top slide, shows you how fast, depending on how you're invested, how fast you can recover from a downturn. And that's also really important. So how you're invested could also determine how quickly your portfolio recovers. And what this shows is from February 19th to present, the dark blue is a portfolio made up of 40% stocks and 60% bonds. The light blue shows the flip, 60% stocks and 40% bonds. And then the green is just the S&P 500, so it's strictly equities. And you can see when the market dropped on March 23rd, the S&P went down about 34%, and it took a long time for a purely 100% stock index to recover.